everybody, welcome to our weekly Wednesday webcast. Today we're going to talk about how to build a recession-proof company. So by now you've heard the news that Glassdoor was acquired for $1.2 billion in cash, which is like a 7x revenue multiple, by a company called Recruit. And you might be asking yourself the question, who is Recruit? Very good question. It's a Japanese company that's been making a lot of acquisitions in this space. In fact, in 2012, they acquired Indeed for somewhere between $750 million to $1 billion, which is like a 5x to a 6.5 revenue multiple. Again, not bad at all. They also acquired Simply Hired, which is more of an asset sale. So Simply Hired had announced they were going out of business, and Recruit swooped in and acquired the assets. So their IP, their customer list, their website, and so forth. So no doubt you're going to be hearing a lot more about Recruit in the future. So what I want to talk about today is, number one, the history of the recruitment tech space. Number two, the incredible story behind Indeed's growth. And number three, the future of recruitment technology. So the global recruitment space is a $200 billion market. And in fact, at any given time, between 20 to 30% of Americans are looking for jobs online. That means 50 million to 75 million people online searching these job sites. That's a lot of traffic. And that is exactly why this type of business is a recession-proof business. When times are good, you're looking to upgrade on that job, and when times are not so good, you're looking for a job. So it's very important to note that when you're building a recession-proof company, you want to be able to make sure that it meets those two criteria, that it's something that people are going to be doing in a good economy and something that people will be doing in a down economy. So how did this whole recruitment tech space even begin? In 1995, a company called CareerBuilder was launched. And in 1999, they actually went public, which from inception to IPO 4-year time frame is actually really short. But of course, it was the whole dot-com bubble that we had when it took you 2 years to go public. The sad part about this story is the founder, Robert McGovern, only owned 2% of the company. And if you've been hanging around the weekly Wednesday webcast, you know that on average, a founder will own 15% of his or her company at exit. So 2% is very, very low. In that same year, 1999, Monster launched. And Monster, for a long time, CareerBuilder and Monster were both the two predominant players. It wasn't until 2004 when Indeed came on the scene, and then everything changed. By 2010, Indeed had 15 million uniques compared to CareerBuilder's 21 million and Monster's 15 million. So you can see that it didn't take them long to catch up. Indeed is a really fascinating story. And in fact, since 2007, they have been profitable. In the 3 years preceding their acquisition, they were growing about 100% year over year over year. So what really makes Indeed such a great company? Well, we're gonna look at the top 10 reasons why Indeed is where they're at today. So number 10, they syndicate sponsored jobs across the web. Now this gives more exposure to the sponsored listings, and it's important to note that this is the primary way they made money. They made money from sponsored listings, and they also had different things like ads and other smaller sources of revenue. So again, diversifying revenue is really important. Number 9, they enabled job alerts, which increased engagement by pushing listings to users. So this kept users coming back to the site over and over and over again. I talk about this a lot on the weekly Wednesday webcast. How can you get your users and customers to repeat the use? And this is one part of the 3-part equation we talk about in Founders Masterclass and 30 Days of Mentoring. Number 8, they executed a global strategy. About 50% of its traffic and 20% of its revenue came from outside the US. This is another common theme on our weekly Wednesday webcast. Globalization opens up new markets for your company. Number 7, they constantly innovated with new features. One example is Indeed Apply, a one-click solution for job applicants who hosted resumes on Indeed. So this reduced any friction from the process. And I would even go as far to say that this is the quote-unquote magic we talk about in our growth equation. Number 6, they produced job trends reports, ratings, and reviews on companies. This content created awareness for the brand and drove traffic. This is the quote-unquote awareness part of the growth equation that we always talk about in Founders Masterclass and 30 Days of Mentoring. Number 5, they created a mobile app. The majority of Indeed's traffic now comes from mobile devices. Indeed is the #1 mobile job app for both iOS and Android in the US and in 30 countries. They now have more than 100 million downloads. Number 4, they introduced an API that let people get paid for putting job content on their sites. This is another example about diversifying the revenue streams. Number 3, They focus on a simple UI UX, unlike their predecessors who went overboard with annoying ads and features. The site employed a minimalistic, characteristic view that made it an enjoyable product to use. Number 2, they took advantage of SEO by making sure their pages were optimized for crawlers, which drove tons of inbound links. And number 1, they pulled in jobs from all over, not just jobs posted to their site, which is what their predecessors did. Indeed had no walls and no boundaries. I would also say that Indeed's founders came from the online recruiting space, so they really understood early on the importance of SEO. Ronnie Kahn was one of the co-founders. He founded Jobs and the Money prior to co-founding Indeed. Now, I always say it's so important to have domain expertise, and here's exactly why. Now, was Jobs and the Money a huge success? No, it wasn't, but he took that experience and used it to build Indeed, so all was not a waste. So how do all these initiatives affect their financials? Well, let's take a look at this chart. So I would actually break it down into 3 different time periods. Years 6, 7, and 8, years 9, 10, and 11, and years 12, 13, and 14. So in 6, 7, and 8, we can see that revenue correlates to monthly uniques, which is doubling year over year. In 9, 10, and 11, revenue slows down to about 80%, 60%, and then 70% growth, respectively, while our monthly uniques still has a little bit of healthy growth. If we look at years 12, 13, and 14, the revenue growth is about the same, 60%, 75%, and 70%, respectively, while the monthly unique growth experiences an extreme slowdown. So from what I can tell of this company, after the acquisition, the revenue composition really changed. It became less focused on traffic from ads and money from ad revenue, and more focused on partnerships and increasing the spend with existing customers. If you think about the addressable market, which is people looking for jobs online, at some point it taps out. And of course, new people are coming into the workforce and old people are retiring, but the number of people you're going to get looking for jobs online eventually maxes out. So again, it's important to diversify your revenue streams, which brings us to the next portion I wanted to talk about, last but not least, is the future of recruitment technology. So right now, we're seeing lots of cool things. Google just announced Google Assistant, which is artificial intelligence pretty much making a hair appointment for you. So how would this come into play for recruitment technology? If you've ever recruited for a job, you know the pain of this is having to go through tons and tons of resumes. And then once you find the resumes you want to talk to, you have to set up the phone calls, which is back and forth via email. Maybe you use a calendar scheduling program. And then you finally have those phone conversations. And that, of course, takes time. And then by the time you meet them in person, you get to know them and it's actually not a fit for what you're looking for. So what if we can use artificial intelligence to actually scan the resumes for us, make the initial phone screenings, and even use something like facial recognition where we can actually see this person's face and we can see, do they look nervous, do they look confident, are they giving away cues that make us learn that they're actually lying to us. And there's lots of different things that we can learn from people's facial expressions. So this is a really great example of how we can use facial recognition, artificial intelligence to make the recruitment process a lot easier. So I'd love to hear from you. What are you seeing in the world? We're in 2018 right now. 2020 is just 2 years away, actually less than 2 years away. So what do you think that the recruitment technology space is going to look like in 2020? Leave me a comment below. I'd love to hear what you think. And as always, if you have any questions for me, just go ahead and leave me an email. My email is super simple. It's just my first name, lili@financeforentrepreneurs.co. I love hearing from you guys. And of course, if you want to check out Founders Masterclass, our 30 days of mentoring, which happens 4 times per year and is coming up very soon, you can check out the links below. I'd love to have you in either class, of course. And I will see you back here next week. Bye for now.